Lakshman.
Yes.
Good to get you back.
Thank you.
You were one of the first people on my mind when I thought, okay, I want to test out this hypothesis because we both use business cycles, and I've even switched to ECRI data now as opposed to ISM because I actually found it more reliable. I really wanted to pick your mind about this recession topic, and I think I've seen some of the things that you've talked about that you're not entirely sure either whether it gets any worse from here, but I just want to get it from you afresh, what you're thinking, and some of the areas that you're kind of digging into on this.
Right now, the bottom line is that we're continuing in an ongoing growth rate cycle downturn. So it's a cyclical downturn. It's not a flash in the pan. It's going to persist. It's pervasive. It's pronounced, become more pronounced. That all is happening, and it has yet to run its course. We don't see an end to that slowdown in sight. Now, necessarily, every time you begin a growth rate cycle downturn, a deceleration in growth, your risk of recession comes onto the table. It's an active risk. Now, that's in contrast to when you're in a growth rate cycle upturn. When you're in a growth rate cycle upturn, recession's off the table. It's just not there, right? When you're in a growth rate cycle downturn, now you have to really have your feelers out and say, what's going on with recession risk? So we made this growth rate cycle downturn call last year. The growth rate cycle is decelerating in terms of output and income and sales and jobs even. And I think that's becoming more and more apparent. I'd say many people who had kind of denied that growth rate cycle downturn really came to it with a lot of vigor at the end of last year, right? And they went, whoa, not only is it as a slowdown, it's a recession practically. That's what they priced in. Now, we didn't see that. And we hadn't called for a recession at that point. Continued growth rate cycle downturn. Now, you then have the Powell pivot, and I think people kind of just flipped and went to the other side of the boat practically and said, okay, recession's off the table, and now there's a re-acceleration in growth. We're going to re-accelerate. The proverbial second half rebound was priced in pretty quickly. Nope. These indicators, the cyclical indicators, are steady as she goes. There is a growth rate cycle downturn that is continuing. That call remains intact, and I think is being proven out actually by the incoming data. We are seeing a continued deceleration in overall economic activity. And the way I would sum that up vis-a-vis like, is there a recession somewhere on the horizon, is that we're slow walking toward a cyclical window of vulnerability. Now, many people think a recession is the result of some shock. You know, somebody did something wrong or something happened that nobody could have predicted, and that's why there was this recession, some negative shock. And that's not how recessions are made. We've been studying this for longer than I care to admit. And the way our basic, the crux of our finding is that there's an endogenous cycle, which is being tracked by good cycle indicators, including leading indicators, which can tell you if you're in a downturn or an upturn. Now, we're in a downturn, and we're looking at the forward leading indicators to see how that downturn is likely to progress. If we begin to see a window of vulnerability opening up, which would mean that our indicators are falling in a much more pronounced, pervasive, and persistent way than they are currently, then virtually any negative shock, any of the things that have occurred over the last half a year, can become a recessionary shock. And so when we say in our parlance we're slow walking towards a window of vulnerability, I think that's a very active thing that we have to keep in mind. And there are, so when our indicators indicate the window of vulnerability is opened up, that's when we'll make, if and when that happens, that's when we'll make a recession call. Hasn't happened while we're sitting here today. Plenty of yellow flags for us to talk about during our discussion now that do have us worried in that regard. And I'd be happy to get into those if you want.
Yeah, because I'm looking different things, but we both look at the business cycle, and I'm seeing similar. I'm not seeing yet really pronounced slowdowns anywhere. I'm seeing the same weakness, and it looks like in some countries that looks quite negative. Say Germany, for example. And the US, not 100% clear yet, but it's edging towards zero GDP growth. That doesn't mean a recession, as we know. But there are some things like semiconductor sales, when I look at that, that are really in free fall.
Yep.
There's certain things are in free fall, anything to do with transport, shipping, and world trade.
Yep.
I think you've been talking about world trade as well.
Yep.
That are interesting, but we had world trade in free fall in 2015, and we didn't get a recession. So I'm kind of these what I'm struggling with. So I'd love to hear, where you're seeing any particular vulnerability or things that you're saying, actually, this is much stronger than we would imagine.
Sure. So when I hear what you're saying about manufacturing, say Germany, semiconductors, and those kind of soft spots, the way that I receive that is very much, that all falls very much in line with global industrial growth. Now, when we look at global growth, the one true international cycle is with industrial production growth.
Yeah.
With the manufacturing side, we're all making parts of each other's end products or a different part on the supply chain. And so that is the truly linked international cycle. It's hard to have linked cycles in services or in construction, for example. But you can really have it in the industrial sector,
Yeah,
and you see it manifest there. So I agree with you. In Europe, the industrial sector quite weak. I think in the U.S., the industrial sector is quite weak. In fact, that would be one of the yellow flags that recessionary yellow flags that I would throw out there is IP growth. That doesn't look so great. It's starting to look closer to recessionary readings. Okay, and that is one of many indicators that would be watched in a recessionary situation. All of this is linked to the global industrial cyclical downturn that we predicted at the end of 2017 based on leading indicators. And the reason I'm bothering to be so specific with these dates is because the global PMI peaked at the beginning of 18. People started to see that in the rear view mirror in early 18, conflated it with the beginning of the trade war rhetoric, and blame the cyclical downturn on the trade war itself. That's not how we got here.
Yeah.
The way we got here is an endogenous cyclical downturn in global growth. That happens when you're in a free market economy, and it happened. And on top of that, I'm not saying the trade war has helped. It's made things more negative, but that came second. So the implication that I would propose is that a resolution of the trade war today would not remove the cyclical downturn. And I think there's a presumption that it would. And that's
Which is why the market wants to trade this news.
Yeah, and there's, it's salient, right? Oh, this happened with this, somebody said this, somebody said that, I can only act on it. But in actuality, the world we live in is a free market economy dominated by free market activity and fund flows and business flows and all of this stuff. And that stuff is inherently cyclical. In particular, when you go to the industrial sector, that has the bigger cycle than the other sectors. And so I think the weak spot in Germany, as you say, in Europe, in the United States, is around the manufacturing sector. There's one other nuance here that's kind of different, is that in this decade, as we all know, U.S. energy production has really ramped up, right? It is what it is. It's a good thing. I'm not saying it's a bad thing. But what it introduces is this notion that, typically we think of high oil prices could be a negative shock. Well, in the current configuration, given the change in the structure of the U.S. economy, low energy prices can be a negative
bigger
shock. Yeah, that could be a negative shock here. It may actually overwhelm what we used to think it was like. So
because we used to think it's a consumer thing, now it's an industrial production thing.
Yeah, so that center of the country has been really doing well. And in fact, I brought a chart on that, which relates to what's going on with sensitive industrial materials prices. And just a quick sidebar here, we love cycles. We back in the 80s developed an sensitive industrial materials price index. It's very different than other commodity indexes.
Is this the JOC one?
Yes.
Which is brilliant, and I now can't get it for free on Bloomberg.
No, you can't.
I used it for years.
I can give it to you. It's the ECRI IPI now. We just renamed it, but we created this for the Journal of Commerce back in the 80s, and it actually when we were putting together the weekly leading index, we needed a good commodity index to put in there, and we created the JOC to do that. Dr. Moore did. Now, every single component, there's about 19 or so in there, is hypersensitive to cyclical moves in industrial activity. Mm-hmm. A feature of the JOC, or the IPI, is that about half of those components are exchange traded and half are not.
That's right.
So there are these moments where speculative forces can kind of do a temporary lift on commodity prices. If there's a supply disruption or a Powell pivot, these kind of things can lift commodity prices and oil for that matter. And they did. You saw that last year with oil. You saw it at the beginning of this year with the risk-on trade. But the non-exchange traded components of the JOC index, the IPI, just keep going down.
Yeah, because it's pure supply and demand.
And so on that demand side, which is where we can really have the insight, this thing's still cycling down. It's not over. So that is pulling down on oil prices, even though there'll be these temporary, maybe today they lifted a little bit, somebody said something, but that ultimate, what's going on with demand growth is anchoring those tradable commodity price inflation. This is totally in line with our global leading manufacturing index, which leads that price inflation, which is still cycling down. We look abroad. China is a big player here. There's a lot going on in China, but one thing of particular note is that their industrial cycle, leading indicator of their industrial production growth, still going down. So you get the theme here. And the theme is very in line, I think, with the sentiments that you were raising at the beginning of our talk.
Absolutely.
And so here, we'll put a chart up for everybody to see, but you have the non-exchange traded components of the IPI index. You see oil prices can deviate here and there, but they can't get away from it. They get pulled right back down to
so it's the core trend of commodity prices, essentially.
Yeah, and it's things that are tough to speculate in, like tallow or burlap.
Yeah,
it's tough to get to put. Not that you can't do it.
Leather's on there as well.
Yeah, you can do it, but you have to get a little creative,
yeah.
And not as easily as just trading oil or copper. Now, what's interesting, and to the point of the double-edged sword on the U.S. economy and actual economic activity, is you could see the relationship with rig counts. Sure, when things go up, rig counts are blowing through the roof. And now this cyclical downturn, that's a very, very, very clear decline in rig counts, and that's depressing
and most people
activity.
miss this because you think in the same way I do, we think of rates of change.
Yeah.
So you've got a rig count it's gone from 160 to 0. Nobody else would have noticed it because they'll have said, well, the rig count's still going up.
They're pretty high.
But
I was just looking at someone yesterday was saying, big truck sales are pretty good. They're pretty high levels. Yeah, it's the rate of change got cut in half. Okay, so that really catches my eye. And that's where the interesting thing happens, is at the inflection point of the rate of change.
Absolutely.
Both at the top and the bottom.
Yeah.
I think, we have another one of our big calls has been, and I think we share this view, is that the inflation cycle rolled over, right? And so in making that call last summer, we have a lot of bond clients, and they're like, whoa, seriously out of consensus. This is going to be a big deal to move this through the committees, right? And that's what it was saying. You had the consensus view, like, I'll pick on Jamie Dimon because why not? He was saying it's going to go, in the fall, he's saying it's going to go to 4 or 5%. Get ready for that. And it topped out at 3.25% in October and November, and you know the story. And
there were signs of this reversing. I thought there was a deflationary trend in place by March of last year.
No, I agree. I think
most people didn't want to see it, but the market didn't want to see it.
No. So our leading indicators, the future inflation gauge actually peaked in February. But we have a whole process, right? So we're saying, okay, is it pronounced, pervasive, persistent decline? We've got to, so we can kind of see these things coming, but the objective call, not reading my view into it, was clear to us by the summer, and then very officially beginning of September, make that call. And it's not over. Everybody got happy I don't know who, but some people got happy on Friday, right? And they said, "Oh, this is great. The economy is booming, and whatever." Future inflation gauge went down to a new 3-year low on Friday. Okay, so this is not over. The elephant in the room has been for some time and remains the inflation cycle downturn.
Yeah.
It's just sitting right there and nobody wants to talk about it.
Right.
And I think it's this level and rate of change thing. Services inflation is up here. It's pretty high. What are you talking about? Or some other inflation is right here. The level is high. It's not about the level of it. It's about the direction of it.
That's right.
And that's what's being missed. But I think the Fed is having to pay some attention to that because the bond market's forcing them to.
So when you're looking at the forward-looking indicators, how far forward, your leading indicators, how far do you think they lead? What is the average kind of,
I'd say,
window
a couple of quarters, a quarter or two. It depends. A long leading indicator can have a lead on a specific economy of several quarters.
Right.
Our very longest leading indicator, which is it's something we call the GIGLY. And we have a lot of acronyms, fun with acronyms, but this is the Global Industrial Growth Long Leading Index.
Right.
And this is for 21 economies.
Yeah.
We strip out the long leading indicators for those 21 economies that we monitor. We strip out the components that are related to the manufacturing sector. Mm-hmm. And we look at a diffusion index of those inputs. Mm-hmm. And that has a lead of about a year over IP growth globally. It's prone to a couple of false signals and very long leads. So we have to have short leading indicators to tune that up, right? So we get a heads up, but you can't necessarily act on any of these because they're so far ahead, but it gets you ready and gets you thinking.
That's right. You're looking for signals.
So we will then see things happen in our shorter leading indicators that lead by a couple of quarters, and we're ready to receive it as a signal as opposed to noise. And then it'll come in, you'll see it in the PMIs or the JOC rate of inflation, and then it'll finally land up on IP. Mm-hmm. Okay, and so we can see it develop, and you can develop your conviction levels along the way as that occurs. So that's why we like things in sequence: long, short, very short, coincident. That's one thing to look at. And then we like broad arrays of indicators. So it's not only manufacturing, but it's also services or construction or trade to get a feel. Sometimes we can get two-speed economies going where say, in 15, 16, it was really this manufacturing impetus to the downside and other elements of the economy were holding up.
Are you seeing evidence of that now? Are you seeing pretty much everything confirming the kind of pervasive downward trend or slowing of growth trend?
What we've had upticks in a slew of our leading indicators away from manufacturing, driven almost entirely by market-related inputs. Right. So in our leading indicators, in our forward indicators, there's basically conceptually 3 buckets. Yep. You get market-related data and derivatives of that. Yep. You get private survey data, and you have hard government data. Yep. And for us to make a turning point call, down or up, it needs to be a pronounced upturn relative to past upturns, persistent, and pervasive. It has to have the majority of the inputs contributing. The reason we know that these little upticks that we've seen are insufficient to make an upturn call, like a so-called soft landing call or whatever, is that it's all been in the market-related stuff.
Because I see this in the weekly ECRI data, which I use, the year-on-year weekly ECRI data, and you've got this kind of, and I know there's a market component of it, but if I look elsewhere at hard data only, it's,
And the weekly data, necessarily, right? You can kind of look around. If you're going to compile a weekly index, it's going to have a little more exposure to the more frequent available data, and the market data is available very frequently. But nevertheless, that indicator hasn't taken off to the upside. No. It's actually still. So that's saying something that, in spite of that,
it hooked back down again.
Right. So it's in spite of that.
Right now, that's very interesting to me.
So that's super interesting.
Yeah.
Of course, we're looking at cycles in growth, but then there's also separate cycles of inflation and even another separate cycle of employment cycles. So these three cycles, growth, inflation, and employment, key aspects of the economy, all have their own distinct cycle. They don't all line up. Now, a model, if you're sitting with working in a model-based environment, you're almost forced to link those.
Yeah.
And that can get you in a lot of trouble because these turning points in these different cycles can have long and variable lags among them and really trip you up. And so here, one of the things that's quite interesting is, you've got this inflation cycle downturn, which is a solid textbook inflation cycle downturn.
Yeah.
It is not about to turn up.
No.
Okay? And relatively speaking, you have, it's all relative here, tight policy. And that's not the way you would think monetary policy should be working, right? You would think that if growth is cycling down and inflation is cycling down, you wouldn't have relatively tight policy. And so that's been the case.
But people
let's
can't
say
see that because
since
they're looking at unemployment.
since last fall, that's been the case. So we're on. I'd kind of call it a 10-month lag at this point, which is a significant lag in the policy response. Now, there's this view that just because the Fed pivoted, that means recession's off the table. Our work says absolutely not.
Yeah.
Even though we're not making a recession call today.
It's not confirmed yet, but everything's still trending.
Yeah.
Now, with the employment data, because that's one of the things that people say, look, the employment number was strong on Friday. We just talked about that. What is your forward-looking employment?
I'm glad you asked. So here's our actual LEI. This is our leading employment index.
Yeah.
And mind you, Dr. Moore was commissioner at BLS, commissioner of labor statistics. So among other things, he knows something about employment cycles. He knew something about employment cycles. And the LEI is in a cyclical downturn. And the coincident employment index is in a cyclical downturn. And that's comprised of inputs from the establishment survey and the household survey and some other data. And that's showing deceleration in employment growth, notwithstanding whatever happened on Friday. There's this big emphasis on freshness, right? So everybody waits with bated breath for the jobs report, and oh my gosh, whatever it said, we'll extrapolate it into the moon and say that that's what's going on. Now, month to month, it's a crapshoot, right?
Yeah.
But the headlines ignore that very much and just run with it. But if you're willing to actually wait, you can get some pretty good data. And so there's the also from the Labor Department, the quarterly census on employment and wages. This comes out quarterly, and we have it through the end of last year. And it shows a very clear deceleration in job creation. Now, unlike the establishment survey or the household survey, this is a census. They literally count every job.
So it doesn't have a birth-death adjustment or anything?
No, this is just let's add them up. Let's count them. That's why it takes a little while. So sometimes the best data is not the freshest, and it's worth checking. The other reason it's, I think, super important to check is because every time you have a benchmark revision to the establishment survey, it's based on the QCEW. So knowing what the QCEW has done, which is decelerate a lot, that the odds of a benchmark revision down is significant. With the latest data, if you look through 2018, basically QCEW is saying that the non-farm payrolls were overestimated in that last year on the order of 25%, consistent with the slowdown in economic growth, which is showing up in all the other data.
Yeah.
So,
which is why the year-on-year rate of change of unemployment is diverging a bit from, let's say, where the ECRI would suggest it would be.
But YOY growth in non-farm in payrolls is at a 17-month low. If you look, nobody wants to look. It doesn't fit with the
headline number.
It doesn't fit with the narrative. Average hourly earnings are high, right?
Yeah.
You're talking about level. Actually, it's
rate of change.
The rate of change is coming down, and when it's coming down, it's basically flat to down a little bit from January. And the reason average hourly earnings is flat to down, or flat from January, is actually because both aggregate pay and aggregate pay growth and aggregate hours worked growth have both been decelerating at the same pace of about 1%. So if they both decelerate, which is a slowdown, right? If you have a deceleration in hours worked, that's a slowdown. That's what that means, right?
Yep.
That's happened. All that's happened is they happened at the same pace, so the ratio stayed flat. But that's, at this point, higher math, and people don't want to do it.
So you brought another chart for me.
Yes.
So I want to see what this one's about.
I brought you a few charts.
Yeah.
We've got there's a leading index of U.S. purchasing managers data, and this has a lead over ISM and market PMIs.
By a year.
And you can see from the chart, it's pretty self-evident, it's in a well-established cyclical downturn.
So this is the interesting thing for me. So, okay, so I immediately, because I play with these all day, I would shift this over here because it's got a year lag. What it's telling me, this is the most interesting bit to me,
Little
the
bit of
last
flat.
6 months,
Yeah.
the flat, because that flat doesn't look like a bottom, that looks like a pause. And if it
So-
breaks one way or the other, will give us some...
Okay, so we don't shift it. What we'll do is the way I'm not saying that you can't do that, and plenty of people doing quantitative analysis on this data do exactly that.
Yeah.
What we would do is look for a three-piece turn. So I'm going to look at this line at the end of the USL, the leading index of the purchasing manager indexes, and I would look at that line and say, is there an upturn?
Yeah.
First, visually, you can just see on a pronounced basis, there's no upturn.
No.
So then I don't even have to say how long has it persisted. And in terms of how pervasive it is, I know that most things are still moving down.
Yep.
So let's get back to the second half recovery. It's not showing up there.
No.
You're going to have to look for it elsewhere. But it's not going to come from the manufacturing sector, and that fits with what we're seeing globally. It hasn't run its course yet. You also have globally some other interesting things occurring which are weighing on this, I think. We had a big stimulus in China. Everybody was happy about that at the beginning of the year, right? Wasn't that the story?
Yeah, that
They're going to
was
save us.
That was January's bull market. Yeah.
That's like ancient history now. But what was going on there is, the Chinese are right in the middle of this global industrial downturn.
Yeah.
They can't hide from that. They're structurally majorly exposed to it, even though they're trying to diminish that exposure rapidly, and they're making some progress. But their Chinese kind of rust belt over the last several years has been seeing more and more provinces contracting. That's very unusual for China. Okay, and for several years now that's going on. Now, domestically, that's a problem for a whole host of reasons. So by our read, a big hunk of that stimulus actually went into shoring up that rust belt. But think of the implications of that. The implications of that is that a bunch of overcapacity just got revived.
Yeah.
And what is the implication of that on disinflationary impulses everywhere?
We could bring the next chart magically.
You bring up the next chart, which is the future inflation gauge. And that just very, I think, cleanly presents. So the future inflation gauge, first off, it's really important just conceptually. I don't know if everybody's familiar with this, and I think the Fed has forgotten this, that the inflation cycle is its own thing. It's not the same as cycles in growth. 3 out of 4 times it follows cycles in growth, but 1 out of 4 is a lot that it doesn't. And so you really need to track this thing on its own. As I said, the future inflation gauge on Friday, we updated it. It went to a new 3-year low. There is no upturn in the inflation cycle in sight. And that looks out a couple of quarters. Part of the story there is the slowdown. It's related to the slowdown. Part of the story there is structural disinflation. And that just had another chapter written by the story I just told about China, where the combination of that overcapacity, what's going on with their industrial production growth, which is cycling down, which largely impacts their producer price growth, which largely has knock-on effects all over the place. So that structural disinflation is not going anywhere. So yes, it is true that services inflation is not
Stickier,
0.
yeah.
It's up there, but it's decelerating. And you have this anchor of this structural disinflation pulling underneath it. And the future inflation gauges, by the way, and I think it's related, are important here for all the major developed economies, are also cycling down. Mm-hmm. In a way, in the discussion, we've got this growth rate cycle slowdown, slow walking towards higher recession risk. We're watching for the window of vulnerability to open up. It isn't open yet. IP is flashing a yellow flag. US IP is already flashing a recessionary yellow flag.
Yeah.
And you've got this wave of kind of these disinflationary impulses still coming. They're not behind
It's interesting
us.
because, if I go to market-based stuff, I look at break-even rates and 5-year and 5-year. I mean, in Europe, inflation is forward gauges of inflation are collapsing. In the US too. I mean, it's happening around the world. And yes, it's a separate cycle, but we're in a secular disinflationary cycle anyway, from technology and aging populations and all that stuff, and debt. But it looks like it's accelerating lower right now, or decelerating rapidly, however we're going to look at it, because it feels that there's something in the whole industrial or trade cycle that is a little more stronger than we would ordinarily see if this was just a soft landing slowdown.
I can't disagree with that, and I see no reason to. But for us to go the next step to recession call, we just have to see our indicators get a bit weaker than they are now.
In that example, for example, you would be looking for this to start falling off.
Yeah, I mean that could
start breaking a range and accelerating,
Yeah,
so its rate of change starts increasing again.
Exactly, it would start to decelerate further, or maybe it doesn't even have to decelerate further. It could just keep not turn up. Not turning up is something.
Right. Okay.
Okay, it's unusual. I mean, this is like, I don't know that it really means anything, but it would be unusual. I don't think that it's ever happened that you've had 4 soft landings during an expansion. Mm-hmm. Okay, I'm not a late cycle guy. I mean, that's not how we think. Mm-hmm. There's no reason that a cycle has to end. Actually, there's no reason that a business cycle expansion has to end. Mm-hmm. Okay, but every time you have a growth rate cycle downturn, you're at risk of a recession and of it ending. Okay, but plenty of developed economies over the last several decades have had 15-year expansions, and just forget about China, India, and Australia. Other ones have had 15-year expansions, so it's not impossible. But I'd be hard pressed to actually point to a U.S. cycle where you actually had 4 soft landings, and this would be the 4th one if it happened.
So 2012, 2015.
So you had 10, 11, 12, 13, 15, 16 were 3.
Yeah.
And we're in the 4th one.
Yeah.
So if everything lights up and turns, the leading indicators turn up, and we have a soft landing, starting right, I'd never say never. That could happen.
Sure.
That would be the first time that you've had 4 soft landings.
Yeah, because the previous super long cycle was 3 soft landings and then a recession. And this one looks somewhat similar. So if we talk, I guess, to sum up in terms of where we are, we're waiting now for the next phase, whether we start to see something more meaningful now, or whether we do see this outside chance probability of a...
Well, I think hidden in what I said earlier is a possible scenario. Okay. I don't want to predict the predictors.
No, and everything's a probability.
I don't want to predict the predictors. We go by our 3 Ps, that's it. I made the comment that the lift that we've seen in a couple of the indicators with the risk-on trade was coming almost entirely from the market-based leading indicators, not from the other ones. Mm-hmm. Okay, and it has to be pervasive to be a real cycle upturn.
Yep.
All right. If, total speculation, some of those market-related indicators that had lifted settle back down, like oil has.
Yep.
Okay, it's not that it hasn't started. That would require the other ones to kick in order to keep the indicators up. Otherwise, they're going to start to fade.
Yes.
Dr. Moore said a number of things that I have to live by. Don't predict the predictors. You're doing really well if you know when a recession's starting, let alone predicting one. Mm-hmm. Okay, and a few other things. Recessions kill inflation. So my gosh, if we actually get a recession with already this disinflationary impulse,
negative.
I mean, you're talking about possible deflation in that sense. But I mean, I don't know. We'd have to watch.
So how, in your experience, how long before we need to see? So I'm not going to ask you to predict the predictor.
Yeah.
I'm going to ask you to predict when we need to know, when we will likely know when your forward-looking things are going to confirm, deny, or give you a change of perspective. How long is that? How long is the window?
Well, before this century, I would have said it more glibly, probably. In the next couple of quarters, it should resolve itself one way or the other. Not a lot of people understand this, but there was a kind of a shift in the cyclical backdrop of how cycles work, or not how they work, but the characteristic of psychochronologies in this century compared to last century, where the relative amount of time spent in deceleration phases, or the amount of time spent there relative to the amount of time spent in acceleration phases has been getting bigger.
Yes.
And because of that, maybe it can last a little longer. I mean, that's very consistent with the decline in trend growth that we've seen, certainly this century and maybe at the end of last century.
Yeah.
So I would say, whereas before I would have said a couple of quarters, let me say a few quarters, but not forever. I mean, this will resolve.
Yeah.
Cycles turn. They want to turn. They do turn.
Yeah, and they either turn lower or turn up.
Yeah.
I mean,
It's not a steady state kind of situation. I think one of the things that's kind of unusual, which is why I brought up the structure changing with energy production in the U.S. One of the things that's been kind of unusual in the last decade has been, while trend growth has come down, right, which we understood and talked about since '08, cycle volatility has also been more muted. Earlier on, I think it was the ramp up in oil production, which helped to do that in a weird way.
Yeah,
all the interventions, kind of extraordinary interventions with debt growth and liquidity and all could be playing a role as well. But as I said, if you have this industrial growth downturn, which is not over, pulling down on energy production, which is more important to the United States now, that can introduce some volatility to the downside that we didn't have before.
Yeah, I think that's interesting. I've been following that myself by just looking at the oil price and thinking, if the oil price breaks lower,
and it's doing this with the lowest production in 5 years from OPEC. It's not that these guys aren't trying to rig the system, but it's still going down.
And if it does break lower, properly break lower, then that has a big impact on the US.
Big impact on the US. Big impact. So we are on high alert watching for this recessionary window of vulnerability. See some anecdotal things popping up, like I said, with IP.
Yeah.
And I think maybe the kind of shift in tone might come around employment this summer, right? As people are kind of slowly, maybe disengaging a little bit, getting ready for the fall. We'll see some of the softness in employment start to show up. Maybe that gives the Fed the cover it needs, right? Because it's sitting here with unemployment low, markets relative, not too far from
And everybody
highs.
thinks everything's all right, but actually most of the indicators are not. And they're screaming that the Fed need to cut.
Yeah, it gets awkward when the president says you have to cut, right? Because and then you're like, oh wait, I can't cut. But actually, I think the actual data, particularly from inflation, also from growth, have the door wide open.
Just makes me still want to buy bonds.
I'm not against what you're saying.
I've been long bonds for quite a while now, and I just think it's the best trade in the world because the equity market's harder to deal with. The bond market reacts to exactly this. Business cycle and inflation, if they're both headed lower,
what are you going to do?
Yields fall.
That's
it's
it's not
as easy as that.
So, I mean, who knows? Maybe the yields will spike up. You can load up some more.
Exactly.
One of the most tell a quick story here. In 1997, super old, okay?
Yeah.
But it's kind of relevant because this is Japan.
Yeah.
And we're predicting a recession.
Right.
And JGBs are at 2 3/4.
Right.
And
it's a long time ago when they were 2 3/4,
I know.
right?
And this fund, a big fund, who couldn't short, right? What are they going to do? They're like, whoa, we can go long bonds, and they just backed up the truck, and that served them well, as you know, for years and years and years. So 3 1/4, that might have been it for a while.
Personally, I think it was. I think, I look at the trend channel of bond yields. I've been using it for 30 years. I've used it my entire career, and it's worked every time.
There you go. I saw that chart. I saw
yeah,
that.
you get to the top of the channel.
Yeah.
And you know what? It looks like they're going to 0.5% or maybe 0.
Especially when you saw, when you have that, they come out of Sintra in 16, they're like normalization, we're all good, and they get it all the way up to the top of the channel.
Yeah, and then before you know it, it all turns again. Lakshman, great. Thanks very much.
Thank you very much.
We'll no doubt catch up within a few quarters' time when we figure out
Yeah.
which way this is breaking. And obviously, if it does break and you've got a strong call, just give us a shout, because I think everyone's super interested one way or the other, whichever way this plays out.
We'll do.
Brilliant.
Thank you very much.
Thank you.
All right.